I wasn't expecting to have a partial credit talk at the sports panel, but Lasry, I think, sat in this chair and said, mark my words, 6 months from now rates are going to be lower, which of course immediately perked up my ears. So I thought, okay, interest rates, credit, that's sports, this is credit, but it threw me off my notes because I thought I would start there. I'd like to hear, that's a big macro call. Anybody want to comment on where you see rates? Because it's going to affect credit, it's going to affect spreads, it's going to affect markets.
I'll kick us off. Hi, everybody. You're so far away, by the way.
I know. It is far.
That's not my base case. So the beauty of markets is we get to disagree sometimes, whether it's buyers and sellers, as A-Rod was talking about. As I think about the trajectory of rates, I listen to what the Fed is telling us. And while they're data-driven, I think the extraordinary focus is on inflation at 2%, which from my perspective, given everything that we see in our portfolios, is still a long way away. So I would expect at least rates will stay higher for longer. Not knowing exactly where we're going to take this conversation, though, I think the bigger question is, has the damage already been done in terms of what's happening in the credit markets? And even when rates go down, which is what everybody's hoping and praying for, it may be a day late and a dollar shy. And I think that's maybe a bigger question, is what has been the impact of the severity and speed of the rate hikes versus when are we actually going to start to see them coming down? But I, for one, don't think that we're going to actually see rates going down in the back half of the year.
Yeah, I'm going to be boring and have to agree with you there, Michael. Look, I think we've been on this economic, science experiment over the last decade and a half, where you ended up with $20 trillion of negative yielding debt. I mean, that's a crazy thought that you had this negative yielding debt, and so you've seen a rate move with the magnitude and velocity we haven't really seen over the last half century, and I completely agree. I think there are lag effects as this plays out, and you saw the movement in gilts over in the UK, and Ivelina could talk about that in September. Clearly, you've seen the bank failures here. Those are just problems that are created because of the movement in rates. We haven't actually seen the effects as it hits the credit market yet, and so. I think that there's going to be a lot of upheaval to come as a result of this rate move. But the problem is inflation is sticky. And so I don't think that you're going to see rates move down relatively quickly here. I tend to agree with Michael that you're going to see them higher for longer.
I mean, what I would say is, why are rates lower? Do we have a recession? Is that why rates are going lower? Or are rates going lower even though the economy is still actually treading water? So that's the big question. Yeah, I can see the rates going down if we head into a recession, even if that's a mild recession. And I can definitely see that happening. I think it's taking longer than I anticipated to actually, again, see some type of economic weakness. I think a lot of that is, quite frankly, driven by the fact that consumers actually saved up during the pandemic, and it's taking them a little bit of time to work through those savings. But guess what? They've been successful. Consumer card debt is back to pre-pandemic levels. And I think that that's going to start catching up from now on. But it is just expanding, again, that period of economy treading water and, again, rates not having their intended effect. So net-net, two possibilities. We head into a recession, rates lower. Is that a good thing? I mean, for a distressed investor, it is. And are rates lower, again, if the economy stays here? I completely agree with Ryan and Michael. I actually think it will be in more trouble if they actually start lowering rates, with sticky core inflation, because I think that it's at that point in time that central banks lose all credibility. I mean, this has been playing out for the past 3 months. They keep telling us rates are staying the same throughout the year end, and the market keeps fading it. And a lot of that has to do with the fact that, in my opinion, the credibility is really not there. And again, that's the scariest scenario. They actually take their foot off the gas a little bit too early, and then we're dealing with high and persistent core inflation for years to come, and that's a scary prospect.
I mean, the Fed's clearly, they're very transparent about wanting to push to slow things down. They're trying to do that. I don't think they maybe factored in some of the consequences of the way they've done it, like blow up regional banks and all of what that creates. But like in our investment committee meetings, and when managers come in to see us, there's this tug of war going on between managers who come in and say they're private credit guys and the underwriting opportunities are unbelievable, and which is obvious. But by the same token, they're unbelievable because in the public markets, security prices are down, rates are up, there's dislocation, there's a lot of opportunity, and so there's this tug of war between where's the real opportunity? Is it in public markets or is it in private markets? Where do you guys see it?
Both.
But where are you focused?
So one thing I
Of
want
course
to
you're
hit on,
huge,
because
so
this
both.
whole rate conversation I just find so fascinating. I've said this to you before, Jeff. The role of a strong central banker is to telegraph their path and execute, because it's all about confidence and credibility. And they've been doing exactly what they said they were going to do for the last 16 months, and the market is hoping and wishing that the outcome is going to be different. And the reason is so many asset owners, public, private, institutional, individual, are owning assets at yesterday's prices on leverage that is unsustainable, unaffordable, or unreplicable in today's market. And I think that is really the heart of this whole conversation, is how much have we propped up asset values based on an interest rate environment that we likely won't see for some time. And the reason that I worry a little bit about has the damage been done is we haven't even begun to see the rollover of leases and auto loans and consumer loans into this new rate environment. So we're beginning to see breakage before we've really digested the new rate environment. It's going to be interesting to see. So the reason I say both is viewed through the lens of where is liquidity valued most. It really depends. Most of the issues, speaking from the distressed or opportunistic credit lens that we typically talk about, are driven by fundamental distress. Companies having operating issues or in an industry going through fundamental transformation. What we're dealing with now is just who's running out of cash first because of the structure of their liabilities. And so that's presenting opportunities in the private market where people are illiquid or less liquid and need to extend runway in their private portfolios, and we're seeing it in the public markets. So this is an interesting set of circumstances, because what we're really focused on is who needs cash, who has cash, and then what's the value and the pricing of that. And opportunities are plentiful in the private and public markets right now, and it's really, the opportunity to pivot is where you're going to drive value.
I'm going to have to start speaking before Michael, because I just keep agreeing with him.
They stuck me at the end, though, so that Jeff is trying to.
I'd have to say both as well. Look, we're constantly looking at the arbitrage between the public and the private markets, and I think in the back half of last year, we really started to see a dislocation, particularly in the high yield and leverage loan and that broadly syndicated market. And we were very focused on the public markets in the back half of last year. And people think during these periods of dislocation, it's a great time to be doing private credit. Well, it's really not, because to Michael's point, companies are loath to put in that implied cost of capital that you're getting in that secondary market for the very low bond prices and that very high current yield. Nobody wants to lock in that cost of capital. So everybody says, okay, we'll just wait. We'll wait until things get better. And historically, you've seen these V-shaped recoveries. Coming into this year, companies can't wait anymore. 85% of the market does not have a maturity for the next 3 years. Well, 15% of it does. People have maturities. People are looking for M&A transactions that they need to close. People are starting to have liquidity issues. And so they're coming to us and people that look like us up here on the panel for these private credit solutions. And you're talking about a high yield market that yields 9%. You have some illiquidity premium, you have some complexity premium. You're talking about very low loan to value, secured, senior secured, that where you're getting mid-teens returns. And that hasn't happened in a really, really long time. And I thought everybody here was excited to come and listen to us talk about credit, and then I realized we were actually just talking after A-Rod. But it is a very exciting time to be investing in credit, and that's on the private side. And on the public side, look, there's a massive bifurcation as we think about the market between what I'll call double B assets in the high yield market that trade on spread. They look a lot like investment grade, and people just trade that relative to treasuries. And then there's that single B and triple C. And those are trading on dollar price, and people really aren't differentiating between the credit quality of those assets. And so what it really has become in the public market is it's a credit picker's market. And there are some great companies that can withstand a lot of the pressures that we're going to talk about up here, that you can make a lot of money buying bonds at really cheap, low dollar prices. And there are a lot of companies, the capital structures don't work in this economic environment, and they're trading at the same level. So it's a great credit picker's market, and so there's a lot of opportunity to make money on the upside, but there's also a lot of opportunity to lose money if you put yourself in the wrong credits in the wrong part of the capital structure. Defaults are going to go up, and the losses are going to be severe.
Go up how much?
Look, I think it's difficult to say. I mean, you got a default rate that's a little over 2% right now, so it's not some bold statement that defaults are going to go up. Look, I think that you could get easily into that mid-single digit into a default rate environment. I have rarely seen throughout the course of my career more companies, take the macro aside because there are lots of variables and everybody can pontificate on the macro, but I don't think anyone knows from dispositively what's going to happen. But when we're looking at our investment committee memos and we're looking at individual companies, we're constantly thinking of, okay, how do we help this business? How do we provide capital to avoid bankruptcy or default? And I'm just seeing company after company that just says, this doesn't work. Like this business doesn't work. This capital structure doesn't fit. And that's if EBITDA stays constant. If EBITDA is going down, it's really bad. And so I'm not saying, okay, we're going into a recession, so default rates are going to pick up because that is like the constant playbook. I'm saying you're looking at a bunch of companies with capital structures that have been built over the last 10 years for a dramatically different interest rate environment, and the businesses have not grown into those capital structures. So we do believe default rates are going up.
One thing I would add on that, though, this is going to be interesting, and this is not true for all private asset classes, but true for most. We are going into this cycle with much higher equity betting and equity subordination than we have in past cycles. So I think many folks who think about credit markets are trained to think about default and less about loss given default. And I think to Ryan's point, there's so much equity that's invested in these assets that is beholden to a discount rate that's no longer available to them. But it's very hard if you're an asset owner of a commercial real estate property or an infrastructure.
Well, that's where I was about to head.
To walk away. And so there is this value transfer happening in the very early days of the credit cycle where the lender similarly sees value below them. And I think we're all trying to build a bridge to a new rate or a new valuation environment because there is still enterprise value, whereas prior cycles, you may have been talking about 20 to 30% equity betting in a leveraged buyout, and today, the market's probably 50% equity subordination. So this will play out differently, and I think the conversations around default avoidance and resolution pre-default are going to be more plentiful now than they have been in the past, given the amount of subordination in the market.
The one thing I would say, by the way, talk about default rates. I always joke that default rates are the most backward-looking characteristic, i.e., like to actually judge health of the credit market, you're looking at forward measures. Forward measures are indebtedness. Forward measures are attachment points. Forward measures are documentation, cash flow burn, interest coverage. Default rates, when default rates usually peak, we are out of it. We're not getting into it, we're getting out of it. And I think that's something that people miss many of the times. If you actually go and map spreads versus default rates throughout time, you're going to see that there is 9 to 12 month lag. And in this instance, I actually think it's going to be longer. It is really interesting to me that what you are supposed to be seeing in this environment, and I completely agree with Ryan, is actually a lot of divergence, i.e. bad companies, bad balance sheets, cyclical businesses coming under pressure, good businesses, good balance sheets really hanging in there. And that is, again, a fundamental view, right? It's distressed 101. What's happening instead is technicals rule supreme, so we're actually seeing convergence. Bad businesses hanging in there pretty well, but good businesses actually coming under pressure because when people see outflows, they sell their winners. So I completely agree, credit pickers environment is actually excellent right now because you can buy some really good businesses at really interesting levels, and you don't actually have to do, the hard work in terms of like buying a bad business and turning it around. And that hasn't happened in like 10, 12 years. And just to add to that, in the public-private question, I have a slightly different answer. Over the past 6 to 9 months, in my opinion, hands down, public was significantly more interesting than private. I think it
Over
was
the past
yieldier.
6 to 9 months?
Yes.
Okay.
I think that basically what happened
Is that in Europe or is that everywhere?
I think that it's everywhere.
Okay.
I think that guys were sitting on a lot of cash in terms of private inflows. And I can speak obviously to Europe, but basically people were getting deals done, in my view, significantly tighter to what you can actually get in public markets. Going forward, I think that's going to change. I think that the change is also going to be predicated on the fact that a lot of allocators, quite frankly, are sitting on 60% private allocation, which was meant to be a 45% private allocation because of a very significant denominator effect. And as a function of that, that inflow in terms of private structures is a little bit more muted. So I think that people are going to be, again, more mindful in terms of where they underwrite deals going forward. But I think the big difference between public and private markets is the fact that I still think that a lot of private debt is not marked to where it should be. And that is really it doesn't matter whether it's private debt, CRE, VC, it's all about the fact that there is a bunch of, risk out there that is most probably...
That's hiding in
that's
old
marked
marks?
to model. That's marked to model. And so I think that there is just a lot of potential for a disruption to the market. You just need to see a mismatch between assets and liabilities for that to ultimately be ignited. But there is definitely a lot of that out there.
So guys, there's two big things that I see in this year. One that everyone dismisses and says this is just political theater and it's not going to happen, which is the Congress not agreeing to raise the debt ceiling, and are we actually going to default or not? And everyone dismisses it. It's hard for me to actually get people to say, okay, there's still a small chance that it actually could happen. And if it actually did happen, then what happens? No one's really knows. Maybe you guys have an opinion. But that's maybe that's not going to happen. What is going to happen is that these, how many hundreds of billions or trillions of dollars of commercial real estate debt, Alpha's Towers, you name it, like that building in San Francisco, there's a whole bunch of this that's there that's coming due over the next few years that completely doesn't pencil out. To me, that's like the elephant in the room, because that's going to happen. When it does, what happens? How does it get resolved? Yeah. And the answer is not just $350 million San Francisco high-rise buildings get sold for $60 million in an auction, which is, you guys have probably read this story. How does this play out? How does this affect your opportunity sets when you look ahead at where you're going to be putting your clients' capital?
Yeah, look, I think we've all been alluding to it to some extent, and you can see it coming. There's $1 trillion of CR debt.
Is that the number, $1 trillion?
$1 trillion.
I hear a bunch of numbers, so.
$1 trillion, yeah, in 23 and 24. And the reality is, there's a lot of leverage, obviously, that's put on things. Asset values have gone down materially. They're going to be unnatural owners if the keys go back to the banks. And kind of gets back to the point that I was talking about earlier. You talk about what's happened with some of the bank failures so far. That's just been an interest rate move and a mark to market for all intents and purposes. It hasn't actually been credit. And so, when these credit losses start flowing through the system, it's going to affect the banks. It's going to affect lending, and all of that is going to cause a lot of tightening. And to the point that Michael was making earlier, with your example with the San Francisco office property, when you remark those valuations, well, what does that mean for the rest of everybody else's portfolio? And if you can go buy that office building at $60 million, yeah, okay, great. There's Class A office space, and that's a more valuable asset. But how much more valuable than the 60 is it? And so I think all of that is going to flow through the system. And what does that mean? That means spreads are going to go wider, and I think that creates a lot of opportunity if you have capital to attack and invest in the situation. And so I like the credit panel title here. Having capital that's coming in, you are able to play offense, and I think you'll be able to buy things extremely cheaply. And then if you own assets right now, you're going to have to play defense on the best assets. And I think people are going to look at their equity checks and they say, I have a finite amount of equity to put in. I'm going to protect my best assets, and the assets that I don't love, here are the keys, and we'll let the banks deal with it. And there are the massive ramifications that flow throughout the credit system once that happens.
I think that's right. There's a lot to talk about around the CRE landscape, and not going down the rabbit hole that all real estate is not created equal. And we're seeing dispersion in industrial and multifamily relative to central business district office. The issue is what you highlight, which is by definition, given the amount of real estate assets that sit in the banking system and the securitization market, it will be constraining credit for quite some time. I don't think that there is any silver bullet that will resolve the challenges of office in key central business districts. There's just not enough demand in oversupplied markets that are uneconomic to rehabilitate to the current market reality. How that plays out, though, is a 10 to 15-year question. I liken it to what we all went through when we had to think about repurposing malls. And there was a lot of consternation about how the markets were going to absorb value destruction in malls. And here we are 15 years later, and we're still kind of grinding through that. So this is going to be a long, slow grind as we try to think about what the ultimate resolution is there, because trading an office building from $350 billion to say just $350 million to $60 million, that's not going to happen. And if it does, the capital is really not there to bring that asset back to par. So people are going to be sitting on zombie assets for quite some time, waiting for some kind of government subsidy or some kind of regulatory support to do what they need to do to make those assets viable. But other parts of the commercial real estate economy are obviously still quite strong with good secular tailwinds that are well capitalized. And so I think we have to be careful that we don't paint all CRE with the same brush. But I do think bank exposure to real estate obviously will mean credit contraction on the heels of bank failures and increased regulation and general deleveraging and de-risking. So part of why we're so excited about the opportunity in private credit is because somebody is going to need to come in and provide liquidity into these markets in order to resolve some of the mismatch between the assets and liabilities that are pretty prevalent.
That probably has some sort of natural effect of keeping some lid on where interest rates go, I would think. Just trying to digest all of that.
Yeah, but you have to think about rates and spreads. So we could all say maybe we're at peak rate, but we have not seen spread widening. And if you believe that the supply of capital is not enough to resolve the demand for capital, you're going to see spreads gap out pretty quickly in the private markets, in my opinion, which means the cost of capital is still going to be quite high.
So guys, talk about like money in motion and what's happening in the credit markets. There's an argument, by the way, we often take the other side of this argument, but there's an argument that scale matters and that scale gives you the ability to do more. And you, Ryan, just bulked up your scale last week or this week, whenever it was, you made that
Monday,
announcement.
yes.
Talk about that, all of you, because you have a different perspective on it.
Look, it's what Michael just alluded to in terms of there's going to need to be a lot of dollars put in to solve what is going to become the credit issue over the next couple of years. And I think scale is relevance as it relates to the market. And obviously a combination of a big private equity brand like TPG that focuses only on private equity and with some real estate, and then AG on the credit side, focus only on credit with the real estate component as well. Bringing that together, that provides relevance to the LPs who are looking for less partners, but they want to do more with it. But more importantly, it provides relevance for all of our investments, and we think about that. Our investments is really our partners that we're working with, and it allows you to provide a solution at every portion of the risk spectrum. And so, to the point that Michael was making earlier, not everything is created equal, and some people need equity-like solutions with equity-like returns relative to that risk, and some people need top of the capital structure, bank debt solutions. And so, you're relevant to every single company in being able to solve their problems, and really that's what scale allows you to do. It is really relevance and to be involved, and that just, if you think about it, just massively opens up your opportunity set. And then with the relevance to the LPs, that massively opens up the amount of capital that you have in order to solve those companies' problems. And so, you're seeing this throughout the industry. The bigger players are just scaling up, and it's really important to the investments that we're looking to make.
I'm most probably on the other spectrum.
Yeah, you are.
But listen, it depends on the market, right? I think size opens eyes when it comes to the States. I think size makes it really difficult for people to actually penetrate the European opportunities in many ways. And that is simply a function of the fact that the credit market in Europe and in the States and Asia, all very different. In the US, you've got big structures, again, like sizable opportunity. It's easy to write 200 to 250 million type of checks or north of that. In Europe, the average size of a credit, leverage structure between public and private is around 500 million, which means that unless you can write 30 to 70 million checks, Europe can be a very cold and lonely place for you for a prolonged period of time. And I think that, again, like as a function of that, being capacity constraint is actually very powerful. That's on one hand. On the other hand, away from the size of the opportunity, different type of backdrop vis-a-vis jurisdiction and legal and restructuring frameworks as well. Again, obviously, the US, Chapter 11, we all know has become very litigious, a lot of creditor-on-creditor violence. And once again, being sizable, being able to dictate the tone of those conversations ultimately puts you in a pole position. In Europe, it's the other way around. The one good thing about, for example, UK law and common law in Europe is the fact that there is this concept of equitability. So, if
Concept of what?
Equitability.
Okay.
I.e., like, if you are a smaller creditor, you still need to be given a look on the side deal for a period of time, no matter who leads that side deal. Therefore, once again, like, being a smaller creditor really protects you to a certain extent. So again, I completely agree in terms of scale vis-a-vis US markets. I think Europe, Asia, Australia, I think that there are definitely very significant differences there. And again, in terms of scale vis-a-vis the market, it's not about, again, like the fact that, people don't appreciate the fact that there is an opportunity. It's, does the opportunity in Europe pay people enough? I.e., like, even if it's a money multiple investment, if you can only buy 30 to 40 million, is it worth it type of thing? And I think that, again, like, if you are capacity constrained, yes, it can be worth it. I think that there is a lot of alpha to be captured, which is quite frankly unique. And just very quickly, I wanted to add to the CRE comment, because I think that that CRE conversation is so different between Europe and the US, and very frequently we were painting it with the same brush. Shockingly enough, when it comes to CRE in Europe, we actually have different problems. The big problem with Europe is the fact that everything literally went to 2.7, 2.8% cap rates. So moving it out to 4.5 implies 30 to 35% write down. So actually, it's not about like people getting back into the office, because shockingly enough, a lot of Europeans have, which is funny because, we're always known to be a little bit more lazy. But we're actually back in the office. The infrastructure is very helpful because European cities are actually pretty well connected, so your commute is shorter. So when you look at vacancy rates in Europe, they're actually significantly lower than the States. But the issue is we're moving from zero rates to, 3-4% rates, and as a function of that, you're just seeing these valuations move down drastically. And again, the problem is centered again around most probably Germany because of really high LTVs, the Nordic market. But again, it's not created equal. So there is systemic threat to a certain extent, less so than the States. But I think that there is so much idiosyncratic opportunity in terms of CRE in Europe because again, there are different plays. Environmental is really important. Everybody's getting upgraded in Europe, and I think that will give us a lot of idiosyncratic opportunities. So again, back to the fact that CRE thematically, systemically, definitely a threat, and it might actually tip us into a recession, if you ask me. But from an idiosyncratic point of view, just tremendous amount of opportunities and different ones, diversifying ones between Europe and the US.
So can we talk about scale? Because I think we're the largest asset manager on the stage, and I think there's a misconception that large managers don't know how to be nimble in different jurisdictions. So as an example, we have a $100 billion credit business in Europe, and we buy loans and bonds, and we do small deals, and we do big deals.
How small deals do you do?
We'll finance companies with 5 million euros or 5 million sterling of EBITDA. In our real estate business, we have a $40 billion European commercial real estate debt and equity business, and we're squarely in the mid-market. So I don't think folks should come to believe that scale managers abandon the opportunity,
smaller opportunities,
to be nimble, because that's where, if that's where the opportunity is, you need to figure out how to get there. I think the reality is, though, if you have 3,000 corporate investments around the globe, you have an information edge that's very hard for people to get when they're small. And I think most importantly, and you see this with every cycle, capital moves to scale, despite the fact that people hate it. JP Morgan's too big to fail, but guess what? When someone needs to rescue First Republic, who shows up? It's JP Morgan. The reason is because they're a safe pair of hands. And there's no evidence to say that scaled managers give up great performance as they scale. It's actually proven to be somewhat the opposite. And so what we're going to see now is capital will flow to scale. The LPs will shrink the number of GP relationships they have because they want to get deployed at size in this vintage, to Ryan's point. The banks will reduce the number of loan-on-loan relationships that they have, and more debt capital in a limited balance sheet environment will flow to folks with scale. So it may not be what we all think is fair or appropriate, but every cycle results in share consolidation and more value going to scale. So the way that I've experienced the markets over numerous cycles now is, I think it's really easy to be smaller and nimble and opportunistic, and you can drive, outperformance. I think it's pretty easy to be really big, and I think it's really hard to be everything in the middle. And the markets are really starting to demonstrate that dispersion. I think allocators of capital are always going to be looking for niche providers that can get them access to some market that they feel they can't access elsewhere. But then there's always value in moving to scale, and the challenge is, how do you differentiate in the middle? And I think Ryan's recent transaction is a great example of two sizable firms already coming together to rescale, if you will, because of the value of that product breadth and information edge and capital access. So it's interesting, just reacting to Ivelina's comments. The goal is, how do you build a scale business without being losing your edge or losing your ability to be opportunistic, but I don't think that they're mutually exclusive.
How much do you guys see the banking disruption, the Silicon Valleys, the First Republic, the Signature, and there's probably going to be, I can't imagine it's really over, but all that lending capacity, it's not really gone because they were acquired, but it's kind of gone because the underwriting that they used is partly what led to their demise. partly. How much of that flows to the alternative lenders to soak up that capacity versus the rest of the banking system?
I think the biggest it's going to come in phases, and this goes back to scale. Phase one, and you're beginning to see this, is portfolio acquisitions, reg cap trades, opportunistically supporting the liquidity needs of some of these banks on the front end. It's not an underwriting issue. You know, the credit in these institutions in the loan books is quite strong. It's their securities book that is hurting them. So it's not a question of underwriting today for the most part, but there's a lot of activity around the market. Folks like us are talking to these institutions about how to be a solutions provider and collaborative capital partner to get them to the other side of this loan deposit issue that they're having. The second, as I said earlier, is capital credit contraction and regulation, which probably means less leverage in the banking system, more regulatory constraint on what banks can and can't do, so on and so forth. And then I think the third.
But the more they can't do, the more that leaves for you to do.
Correct. I think the biggest opportunities are actually going to get created in the securitization and asset-backed market as the larger banks who are proving to be more resilient and stronger than the regionals. Similarly, you're going to have to figure out what's my core business, where do I want to invest, how do I leverage my origination in this new reg cap framework, and who can my partners be on the private side to actually, continue to do that business. I'm not sure that some of these mid-market suburban office exposures, for example, on regional bank balance sheets are going to be all that attractive in the secondary or primary market for folks like us. So it's going to be a combination of secondary and primary opportunity, but I think the biggest long-term opportunity is going to be credit contraction and growth in the asset-backed side of things, because that's a scaled market that's easier for us to access.
Yeah, and look, I think you saw example of really the paradigm shifting prior to anything that was happening with the banks. As there's disintermediation between the large-scale private players coming in, providing credit directly to LBOs and directly to the private equity sponsors, and that not going through the bank and the syndication process. And so I think that will only continue, and the goal is for these larger-scale players to figure out, okay, how do you work with the banks? How do you work with their distribution network? How do you work with all the relationships with all their companies? Because that began to start to get at odds with one another as large-scale private players were disintermediating the banks, and so there is a transformation that has taken place. The goal is clearly to not disintermediate, but to partner and figure out how. But that remains to be seen, and I think that'll play out over the next 6 to 12 months.
I think there is also an element of yieldier product is going to go towards alternatives. Tighter spread stuff is going to go to the banks. Why? Because of how banks think about risk-weighted assets vis-a-vis, again, like tighter credits, healthier credits, and the fact that it's significantly more efficient for them to own it in terms of balance sheet, as opposed to, again, like the more levered, yieldier stuff. So I agree with Ryan. I think it will be marriage of those two to actually provide a solution that, again, like can fit the situation. But again, I know it's simplistic, but what has been happening over the past 6 to 12 years, again, vis-a-vis regulation of the banking sector, it has been easier for them to lend to, again, like IG, healthy businesses, because of how that gets treated. Whereas obviously for us, absolute yield matters. So I think that you're going to see, again, opportunities on the private side there as well.
It's going to be fast. I mean, there's 4,600 deposit-taking banking institutions in the United States. That's down 50% from where it was 25 years ago. I think Germany has 50. So there's
4,600 versus 50?
Yeah, I'm just saying, I mean, there's no reason. We have this love of
Right.
super regionals and community banks, and they do play a very important role in the local markets. But, back to the consolidation theme, there's I think, strong reason to believe that with this, regulatory and credit contraction, that you'll also start to see consolidation either forced by the regulators or forced by the markets. But one of the reasons why the market's been able to absorb, some pretty high-profile bank failures is because the U.S. market is probably overbanked. And so we're all experiencing it as a cause for concern and saying, why aren't the regulators more and more concerned? I think the reality is that consolidation is probably beneficial, and it's been a long-term, multi-decade trend that's probably going to accelerate now.
That red light's flashing. I think we're supposed to stop. Are we supposed to stop? I think that's great. You guys, I think the most interesting thing I heard was the comment you made, Mike, about how large lenders, large platforms like Ares will go into the small markets, because when we get pitched by credit managers, which we do often, one of the strong arguments is you're not going to see this level of deal flow. You have to work with the smaller firms because it moves our needle and it doesn't move theirs, and they want me to end this. So with that, we're done.
Great, thanks,
Thank you.
Kevin.